If you own property, invest in property, or dream of stepping onto the property ladder, is the housing bubble about to burst? And if you're new here and wondering why the hell you should listen to me, I'm Will Gale, and since 2013 I've founded and run two national property businesses: British Homebuyers, a UK-wide home buying company, and British Homesellers, a nationwide estate agency. And those businesses have been involved in over 14,000 property transactions over that time, worth over £4 billion. We deal with over 500 properties a month, and on this channel I give you the truth about the UK property market without all the fluff. So is the housing bubble about to burst? Let's dive in and look at the data. Because for over 20 years, Britain's housing market has soared. Prices have jumped over 215% since the year 2000, from the average house price being £85,000 to today being over £268,000. But what's happening now? Well, there are signs that the property market may be struggling. In this video, I'm going to break down the three biggest warning signs that display how the UK's housing market is struggling, with data, charts, and a few home truths that estate agents might not want you to hear. I'm not trying to fearmonger, I just don't want you to blindly assume the past will match the future, that you will automatically grow the same wealth through your homes in your property in the same way many of you may have done over the last 20, 30, 40 years. So let's get into the first warning sign. Warning sign 1. Real house prices have already fallen. The uncomfortable truth is house prices have already fallen silently once you account for inflation. Let me explain. Everyone loves looking at this chart, showing house prices are rising and rising and rising. Sure, house prices dropped in 2008, but look how they've recovered since. And of course, when you look at the Halifax and nationwide price data, it is exciting to see that house prices increased 4.7% last year. But, and this is a big but, it doesn't take into account inflation. And as we all know, inflation is the silent killer of wealth. This is a graph you don't see so often in the headlines. This graph shows house price growth adjusted for inflation. So if house prices go up 3%, for instance, but inflation is actually at 6%, in fact, in reality, house prices relative to inflation would have fallen 3%. That's essentially the calculation this graph shows, period by period. To give you some perspective to compare this against, this is the same graph showing the S&P 500 index price adjusted again for inflation. You can see it is clearly outperforming property adjusted for inflation. When it comes to building underlying wealth in your home, in your property investments, or capital appreciation in your property investments, you have to consider house price growth relative to inflation, which, as you can see here, since the 2008 financial crash has overall been falling and generally been pretty stagnant. This is not the sort of graph that is usually shared, but in reality, it is the most accurate way for you to understand house prices. A good way to understand where wealth is being created or destroyed in property is in reality to look at the same graph like this. This shows how in the 70s, 80s, 90s and early 2000s, house prices were consistently growing above inflation. That green area you can see there. And that is what was creating all that wealth for those property owners. Whereas you can see that all changed after the 2008 financial crash, where in reality, house prices were consistently growing below the rate of inflation. The one exception was that green peak you can see there on the right, which was over the COVID property boom, but it's now back in the red again. So the challenge here is society needs to reset their views on how much money we will all make from property on average. The next warning sign helps explain this point further. Warning sign 2, the gap between wages and house prices. This is the problem no government has fixed. And ultimately, it's an elastic band that has been stretching and stretching and stretching and can't stretch forever. In 2009, after the financial crash, the average property dropped to about 5 times the average salary. By the end of last year, 2024, it's averaging over 6 times. But this is where it gets more interesting. 6 times earnings is just an average. As you can see from this map, the price to earnings ratio of property is far higher down south compared to up north. In England, for instance, the average is 8.6 times income. In Wales, it's 5.8 times income. And in Scotland, it's 5.6 times income. These here are the least affordable areas in the country to live in. Pretty mad, isn't it? And here are the most affordable places in the country to live. Even the most affordable places in the UK right now look expensive when you compare it to the average house price back in the 90s. So look, clearly house prices can't run further and further from average wages forever. Or can they? This is how they've been able to so far. More and more property is sold to dual income homes rather than a single person taking a mortgage. Mortgage terms get longer. Could we see 40, 50-year mortgages, for instance? And interest rates get lower, increasing debt that can be borrowed. It's these things that have ultimately helped house prices spread further and further away from average wages. But ultimately, all these things will hit a limit. That elastic band will snap. The next warning sign will make you question if experts are experts at all. Warning sign 3, experts can't agree because nobody knows. All right, this is where things get messy because depending on who you ask, UK house prices are either holding steady or quietly crumbling beneath our feet. Here's what the 4 biggest house price indices are saying right now. If we exclude Rightmove, since they track asking prices, not sold house prices, the average annual growth across the land registry data, the Nationwide and Halifax data is about 4%. But monthly changes are starting to stall, sitting at an average of negative 0.2%. So who do you trust? Well, that's the problem. Each of these reports tracks different parts of the property market. The land registry is in reality the most accurate. It tracks all completed sales, but it's also the slowest with a lag of many months. If you agree to buy a property today, for instance, it will take you months to exchange and complete on that purchase, and then a couple of months for that transaction to update on the land registry to then be shown in the data. Whereas Nationwide and Halifax data use mortgage approvals at the moment, which are quicker to reflect the market, but only cover transactions from buyers borrowing money from them. So they entirely miss cash buyers, which equates to 30 to 40% of property transactions at the moment. They're probably more likely to pay lower prices because they're cash buyers, and buyers buying with other mortgage providers. And in terms of Rightmove, they're tracking asking prices. So they're basically a reflection of what a seller's expectation is, not what people are actually paying for those properties right now, which is clearly a problem when over 80% of properties sell below asking price at the moment. So this is why nobody really knows what the clear picture is right now. Prices could be up 5%, flatlining, or sliding 0.5%, dependent on which stat you lean on. But when you zoom out, all these numbers are below inflation. So even if prices are technically rising, real house prices adjusted for inflation are flatlining at best, or falling a little. And when you look at CIPH, which is inflation adding in housing costs, the real inflation we're in reality all still feeling is at 7.5%. That elastic band is stretching. That creates pain and uncertainty, and it's that uncertainty which is one of the biggest warning signs for what might happen next. What does this all mean for you? Look, I'm not saying we're heading for a property crash, price crash tomorrow, but the data is clear. Prices are stagnating or falling in real terms. Affordability is stretched beyond breaking point for a lot of people. Borrowing costs remain high, and government policy isn't helping, but probably deliberately. In fact, I think in reality, the government wants house prices to stay growing below inflation to avoid the situation getting worse. You keep the headlines of house price growth when in reality, adjusted for inflation, the situation is very different. So if you're a buyer there could be opportunities, but you need to be cautious. If you're a seller, it might be time to adjust your expectations. We're not in a property boom. And if you're an investor, the days of quick capital gains might be over. It's really all about yield and strategy right now. Buy to add value, buy in high yielding growth areas to outperform the average. What do you think? Are you seeing this in your local market? Let me know in the comments below. I reply to everyone. And if you found this video helpful, make sure to like and subscribe, and I'll see you in the next one up here.